Okay, today's lecture, or this afternoon's lecture, is on the topic of the gold standard in theory and in myth. And the mythology of gold, as we might call it, really grew up with John Maynard Keynes. Okay, actually, myths were starting to develop about the gold standard even before Keynes wrote in the 1930s. They began to grow up with the quantity theorists at the turn of the century, including Irving Fisher. In today's world, in the post-World War II era, the mythology of gold substitutes for any sort of sound analysis of the gold standard. So what I want to do is to give some of the more prominent myths and then to show how they are not based on sound theoretical reasoning, at least from the Austrian point of view. And then I want to talk a little bit about the plans for a transition back to the gold standard and some of the difficulties that we will face in such an endeavor. Let me just show you some of these myths. I think it's ready. Okay, these are the 6 myths I'll deal with. The first is that the gold standard is unable to accommodate the monetary needs of a growing economy. Since our economy is growing from year to year, it is said that we require an increased money supply to accommodate the exchange of these additional goods. Secondly, under the gold standard, the quantity of money is arbitrarily determined. That is, it's determined by the costs of mining and by other factors that may influence the demand for money, or rather the demand for the use of gold as a non-monetary commodity. Okay. It's not in any sense planned in a rational way. That's what they mean. That's what this means to say. Thirdly, the gold standard is a government price-fixing scheme writ large. This is a particularly monetarist critique that setting a fixed price of gold between the dollar and a unit of gold is nothing but a price-fixing scheme. And why would Austrians who believe so passionately in a free market fall victim to, or advocate such a scheme? Fourth, the international gold standard subjects a country to alternating bouts of inflation and deflation. That is, the money supply depends almost solely on what is happening to the balance of payments in a country. So if you have a surplus in the balance of payments, gold flows in, your money supply increases. Whereas a deficit will result in a contraction of the money supply, and with corresponding effects on the price levels of those countries. Fifth, the gold standard involves high costs in terms of resources devoted to gold mining, as well, and even more importantly, as a sacrifice of productive uses of gold in industry, for example, in electronics, in dentistry, in jewelry. And sixth and last, the gold standard results in high interest rates that discourage investment and retard economic growth. This was a particular critique of Keynes, of the gold standard. Well, I think basic supply and demand analysis in most cases will show us that these are certainly just myths, okay, and are not correct representations of how the gold standard actually works. So let me start with the first myth, the fact that the gold standard is unable to accommodate the needs of a growing economy. We might begin by pointing out that the decade in which we've had one of the greatest rates of growth in the United States was in the 1880s, okay, and I have some statistics here regarding that. So historically, it's certainly not true that the gold standard stunted growth. In fact, throughout the 19th century and up until World War II, a mild deflationary trend prevailed in the industrialized nations. So despite the rapid growth that occurred as country after country industrialized in the 19th century, we had a gold standard in place. And this certainly didn't prevent that rapid growth. To go on, the reason for this was that the supply of goods did outstrip the supply of gold money, and yet there was growth and falling prices at the same time. And for example, in the U.S. from 1880 to 1896, the wholesale price level fell by about 30% in 16 years. That's about 1.7% per year. And those figures come from Friedman and Swartz. At the same time that the price level was declining, okay, after the U.S. had gone back to gold in 1879, at the same time that we had this decline in the price level, real income rose by about 85%, or around 5% per year. Okay, one of the most rapid, prolonged rates of growth in U.S. history. Aside from infrequent discoveries of major new sources of gold, this inflationary trend was only interrupted during periods of major wars, such as the Napoleonic Wars that Britain fought in from, as I said, 1797 to 1821. Britain had gone off the gold standard, and as a result did experience rapid inflation. And also, of course, the U.S. During the Civil War. Okay, but yet, after they returned to the gold standard, prices then continued to fall. And that didn't impede growth. Well, that's the history of it. Okay, and there are many other instances of increases or high rates of growth coinciding with the gold standard. But what about the theory? Well, the theory can be explained, I think, with a simple supply and demand diagram, in which we put the money, total stock of money in the economy, on the horizontal axis, and the purchasing power of money, the value of a money unit, or to put it another way, the amount of various units of goods that can be purchased by a unit of money. We can put that on the price axis. That's equal to 1 over P. So, for example, if you pay $10 for a compact disc, well, then the value of money in terms of the compact disc is 1/10 of a compact disc. If a personal computer costs or has a price of $1,000, well, then the value of money of $1 in terms of personal computers is 1/1000th of a personal computer. So as we said earlier in the week, the purchasing power of money is an array of alternative quantities of goods that can be purchased by a unit of money, in this case the dollar. So let's take a simple example. Let's say the quantity of gold at a given point in time is fixed, and so we draw a vertical supply of money, M. Okay. Well, let's have MS for money supply. And we have a certain demand for money, a certain amount of money that people wish to hold and wish to purchase with their labor and other goods that they're selling. And let's say that the money supply in billions of dollars is $100 billion. Okay. Now, what would happen if suddenly we had a 10% increase in the supplies of goods and services produced in this economy? Well, in effect, the sellers of those goods would want to sell those goods, okay, at going prices. That would mean you would need 10% more money to be able, for the economy to be able to absorb those goods. So in effect, okay, if this is the money demand before growth, MD1, in effect what would occur is that the demand for money would increase. So now the demand for money would be 10% greater. Okay, so now you would have quantity demanded for money at the given purchasing power of money, at the given amount that money can purchase, ppm1, it would now be $110 billion. But there's no Fed to create this additional $10 billion that we need. So how did the gold standard handle that? Very simply, okay? If I can direct your attention for a moment to the high-tech industries in the last 20 to 30 years, how did they handle the fact that the supply of personal computers and software and so on was increasing so rapidly that it was outstripping even the inflationary rate of growth of the money supply caused by the Fed in the 80s and 90s? Well, how did those additional computers get sold? The point is that because of the technological advances and increase in investment in those industries, costs fell. So that when the supplies of computers increased on the market, their prices fell. So, again, to give you an idea of the magnitude of this fall, we can go back to history, recent history in this case, and see if I have the statistics here. I believe I do. Yes, I do. A mainframe computer sold for $4.7 million in 1970. Okay, while today one can purchase a personal computer that is 20 times faster for less than $1,000. Okay, so we had a substantial price deflation in high-tech industries, and that did not impair the growth in those industries, this fall in prices, because it corresponded to falling costs due to technological advances. In fact, we can point out that there was an enormous expansion of profits, productivity, and outputs in these industries. This is reflected in the fact that in 1980, computer firms shipped a total of just about 500,000 PCs, while in 1999, their shipments exceeded 43 million units. So it increased 86 times. All right? And that's despite the fact that quality-adjusted prices had fallen by over 90%. So the point is here, as people bring their goods to market, there's been an increase in the supply of goods because there's been technological improvement, as I said, at lower costs. They bring these goods to market. What happens is exactly what happens in the high-tech industries, except it happens economy-wide. Or not necessarily economy-wide, in those industries in which you have growth. So their prices will begin to fall. As their prices fall, each dollar will be able to purchase more of that particular good than it did before. So there's an excess demand for money, a shortage, so-called shortage of money, but it's only temporary on the market. What happens is that as the value of each dollar increases, we move up along the demand curve to this point. So that at the end of the process, prices are 10% lower, or roughly 10% lower, and the purchasing power of money is roughly 10% higher. Okay? So each gold dollar can now purchase 10% more than it did before. Now, what does that mean? If you look at the total amount of goods that can be purchased, for example, if we have a situation where the good was originally, let's say, $10, right? So that means that a dollar could purchase 1/10, and now it's $11. So now the dollar can purchase, I'm sorry, $9, excuse me. The dollar can purchase approximately 10% more. What happens is that the real supply of money increases. The real supply of money is the money supply over the prices. So if we take this particular good, initially we had a money supply of $100 billion, and we had a price of 10. Okay. So the number of units that could be purchased by that money supply was 10 billion. Okay. But as the price falls, okay, I'll move it over. Oh, I hit the, thank you. Okay, there we go. If it falls to $9, the same $100 billion of gold, okay, which hasn't changed, there's no Fed, okay, increasing the money supply, can now purchase over or around 11 billion units of the good. Okay? So you don't, the market process will adjust the purchasing power of money so as to enable the additional goods and services to be sold on the market. And they will be sold profitably on the market because costs are also falling. Okay? That is the reason for economic growth. So that's the simple supply and demand, or the basic supply and demand theory that shows that the first argument against the gold standard is purely a myth. Okay? It's refuted by theory and by history. All right, what about